Today's company is one that most people in 3D printing have touched without ever buying a single thing from them directly. Here's my thesis. Materialise is the company that figured out, way back in 1990, that the durable money in additive manufacturing was going to be in software and services, not in the printers themselves.
And they figured it out so early that for a long time, nobody was even competing with them for it. This is a Belgian company founded by a guy named Fried van Kraayen that ended up sitting in the workflow of a huge chunk of industrial 3D printing while also quietly becoming a serious medical device company.
Which is such a weird combination on paper. Build preparation, software, and custom skull implants under one roof.
It makes more sense than it sounds. And we'll get to why. We've got the origin story, the products that actually explain the company, a CEO who's been making some pretty sharp cuts, and a big open question. Can a company this focused on margins and discipline actually grow again?
One caveat before we start. Some of the big headline numbers you see attached to this company, revenue figures, employee counts, patent counts, we could not independently pin down in our research. So when we cite scale, treat it as the company's own framing unless we say otherwise. So 1990. For context, that's before the web browser exists. Stereolithography is a few years old. And Fried van Kraayen buys a 3D printer and starts a company around it in Leuven, Belgium. Now, I'll flag that the exact founding year detail comes from the company's own telling. Their about page just says over 30 years of experience, but the timeline holds together.
And what matters isn't the year, it's what he did with the machine. Because in 1990, a 3D printer is an expensive, temperamental prototyping tool. The obvious business is print parts for people, which they did. But the less obvious insight was that the machines were only half the problem.
What do you mean, half the problem?
Getting a CAD file into a state where a printer can actually build it, fixing broken geometry, orienting parts, generating supports, nesting builds. In the early days, that was miserable manual work. Materialise built software to solve their own service bureau's problems, and then realized everyone else running these machines had the same problems.
So the service business becomes a kind of laboratory for the software business. They're their own first customer.
That's the founding bet in one sentence. Sell the parts, but also sell the tools you built to make the parts, and run both at once for 3 decades.
It clearly worked out for the founders personally. Forbes ran a piece in 2021 with the headline about how Materialise's founding couple 3D printed $1 billion fortune. Which is a great headline, but worth noting that's a stock-based valuation from a moment when 3D printing stocks were flying. That number is paper wealth at a peak, not cash in a vault.
And 2021 was a strange year for additive manufacturing valuations across the board. But the underlying point stands. This went from one printer in Belgium to a publicly traded company on NASDAQ. That's a real journey, regardless of where the stock sits on any given day. The other thing about starting in 1990 is you survive every hype cycle this industry has produced. The consumer 3D printing bubble, the industrial hype wave, the SPAC era. Materialise predates all of it and outlived most of the companies born in each one.
There's a survivorship credential there that's hard to fake. Okay, so let's get into what they actually make, because I think the products are where this company stops being abstract. The product everyone starts with is Magix. This is their build preparation software, and the company calls it an industry standard. I want to be careful with that phrase because it's their marketing language, and we don't have an independent survey backing it up.
Fair to flag. What I'll say from having spent time around industrial shops and now teaching this stuff, Magix shows up a lot. Anecdotally, it's the tool people reach for when they're preparing serious metal or polymer builds. But that's my anecdote, not data. And anecdotes are exactly how marketing claims launder themselves into facts.
What does it actually do that a free slicer doesn't? Because listeners with a desktop machine at home might be thinking, I already have build prep software.
The gap is enormous. A hobby slicer takes one clean STL and makes G-code for one machine. Industrial build prep means repairing geometry that came out of 5 different CAD systems, nesting dozens of parts in a single powder bed so you don't waste a €2,000 build, generating supports that a technician can actually remove, and doing it repeatably with a paper trail. When a build failure costs you a day in a pile of metal powder, that software pays for itself fast.
The newer layer on top of that is CO additive manufacturing, which the company describes as a production management platform. Basically, software for running a whole additive factory rather than a single build.
Order intake, scheduling, traceability, quality management across a fleet of machines. There's a case study on their site about EOS using CO additive manufacturing to manage production at scale, which take with the usual case study salt, but it tells you who the target customer is. And this got a real update recently. Trade coverage at 3dprint.com confirmed they launched new CO additive manufacturing tools in November 2025, aimed specifically at serial manufacturing.
Serial manufacturing meaning repeat production of the same part, not one-off prototypes.
Which is where the whole industry keeps saying it wants to go, and where the software requirements get much stricter. Prototyping tolerates chaos, production doesn't.
Then there's the medical side, which honestly deserves its own episode. The recent headline there, in February 2026, per coverage at All 3DP, Materialise launched custom peak implants for craniomaxillofacial surgery. So patient-specific implants for skulls and faces printed in a high-performance polymer.
And notice what connects all three of these products: Magix, CO additive manufacturing, custom implants. They're all about controlling the workflow between a digital design and a physical part someone is willing to trust. An implant is just the most extreme version of that. The qualification burden is brutal, and the part has to fit one specific human. That's the same core competency as build prep pushed to its logical limit.
That's actually the answer to my question from the top. Software and skull implants aren't two businesses. They're one competency, workflow control, sold at two very different price points. Let's talk about who's running this. Fried Van Craan founded it and led it for most of its history, but the current CEO is Brigitte Devey, and she's been giving interviews. There's one at All 3DP and coverage at Voxel Matters, where she frames 3D printing as a complementary technology, not a revolution that replaces everything, but one tool among many.
Which sounds like a small rhetorical choice, but in this industry, it's almost heretical. The default CEO script in additive for 15 years was disruption of all manufacturing. Saying complementary out loud is a signal that you're pricing your own strategy against reality rather than against a pitch deck.
And the actions match the rhetoric. Multiple outlets, TCT Magazine, Globe Newswire, Quiver Quantitative, confirmed that under her leadership, Materialise transferred two businesses out to their own management teams, Rapid Fit and the eyewear business.
Two readings of that. The generous one is portfolio discipline. Those units grow better independent, and the core company focuses on software and medical. The less generous one is that you're shedding businesses that weren't performing and dressing it up as strategy. The public record supports the transfers themselves. The motive is interpretation either way.
The framing around it in coverage is margin improvement despite flat revenue, though I'll note the specific margin numbers weren't in our verified material, so hold that loosely.
Cutting your way to better margins is a real skill and a legitimate strategy. It's also the easy half. The hard half is what you do after the pruning, and that's the part we can't judge yet. One honest limitation here: beyond DeVet's public interviews and the founder story, we don't have good sourcing on the broader executive bench, ownership structure, or internal culture. So we're not going to invent color there. What we can say is that the visible leadership moves, the spin-offs, the complementary framing all point in one consistent direction, narrow the company down to what it's best at.
Which is a nice segue, because what exactly is it best at? What's the actual moat here? The company's pitch, and you can read this on their partnerships pages, is that they're machine agnostic. Their software connects to printers from lots of different manufacturers through what they call build processors, basically translation layers between their software and each machine's native language. I've seen the claim that this covers hundreds of printers, but I want to flag we could not verify that number, so let's just say many.
The number matters less than the position. Think about what a build processor actually requires. The machine OEM has to hand you enough access to their hardware that your software can drive it well. HP did that. There's a long-running partnership there going back to at least a 2017 interview on Materialise's own site, plus independent coverage at engineering.com in 2023. EOS did it too, per that CO additive manufacturing case study. Each one of those relationships took years to build, and that accumulated trust is genuinely hard to replicate.
It's the Switzerland strategy. Everyone else is fighting to sell machines, and Materialise sells the neutral layer that all the machines have to talk through.
With one big vulnerability, and it's worth sitting on, neutrality only works if the OEMs keep cooperating. Every major printer manufacturer would love to own its own software stack end to end because software margins beat hardware margins. So if the big OEMs decide their bundled software is good enough, the neutral layer gets squeezed from both sides.
It's a funny mirror image of the company we profiled a few weeks back, Stratasys, which built its whole model on keeping people inside its ecosystem. Materialise built its model on being the thing that works across everyone's ecosystem. Two opposite bets on the same question of openness.
And notably, the open bet has been cheaper to maintain. You don't have to fund hardware R&D or carry factory overhead to be the workflow layer. The other pillar of the moat is quality infrastructure. They market a quality management system alongside the software. And on the medical side, they've spent decades building regulatory muscle. That's less visible than a clever algorithm. But if you've ever tried to qualify an additive part for anything safety critical, the paperwork is often harder than the printing. A company that has already walked implants through regulators has an asset most software startups can't buy.
What about the patent side? The number that floats around is 488 patents. But again, we couldn't source that independently.
So treat it as a company claim, and honestly, patent counts are a weak proxy for moat anyway. I'd weight the OEM relationships and the medical regulatory track record far above the patent portfolio. Those are the things a competitor can't replicate in a funding cycle.
So the moat, stripped of the marketing language, trusted neutral position between OEMs, workflow software that shops already depend on, and regulatory experience in medical, real but not invulnerable. Where does that leave them in the market? The customer list, where we can actually verify it, is genuinely demanding. On the aerospace side, 3D printing industry reported their involvement in the Eurodrone program, the big European defense drone project. And medical is clearly a load-bearing segment, with coverage at Medical Device Network and analyst commentary at Seeking Alpha, pointing to the personalized implant and surgical planning business.
The company also talks about automotive, but I'll note our verified sourcing didn't actually back that vertical up, so I leave it as unconfirmed. Aerospace and medical alone tell you the positioning, though. High regulation, high consequence industries where the qualification burden is a feature, not a bug, because it locks out casual competitors.
There's a patient count figure the company uses. Over 60,000 patients helped in 2024, which again, we couldn't trace to a clean, independent source. But even directionally, the picture is a medical business operating at real scale, not a pilot project.
And competitively, they occupy an unusual slot. On software, they're up against OEM bundled tools and a handful of independent workflow players. On medical, they compete with specialized implant companies. On services, they compete with every contract manufacturer with a printer farm. Nobody competes with them across all three at once, which is either a diversified strength or a focus problem, depending on your mood.
The financial picture complicates the story, though. The framing and analyst coverage is flat revenue with improving profitability. Our sourcing on the exact numbers is thin. Voxel Matters described 2025 results as stable, so I don't want to overclaim. But flat is doing a lot of work in that sentence.
Because if medical is genuinely growing and it's described everywhere as the growth engine, then flat overall revenue arithmetic means something else is shrinking. The commentary never quite says which part, but you can't have a growth driver and a flat top line without a drag somewhere in the portfolio.
That would also explain the spinoffs. If you know parts of the business are dragging, moving them out makes the remaining company's story cleaner.
Cleaner and smaller, which is the honest trade-off nobody puts in a press release.
That brings us to the turning points. And for Materialize, the recent ones are less dramatic than a lawsuit or a recall. They're financial engineering. In late 2025, per reporting at 3D Printing Industry, the company announced a 30 million euro share buyback and pursued an additional listing on Euronext Brussels alongside its Nasdaq listing.
Both of those are messages more than mechanisms. A buyback says, we think our stock is cheap and we'd rather return cash than chase acquisitions. The Brussels listing says, we want to be closer to European investors who might value a European industrial company better than U.S. markets have. For a company that's been public on Nasdaq for a decade, adding a home market listing is a quiet statement about where they think they've been misunderstood.
Worth adding, coverage at Stock Titan indicates the buyback was subsequently paused. We don't have deep detail on why, but a paused buyback is at minimum a data point that the capital return story isn't running on rails.
Buyback pauses happen for boring reasons and interesting ones, blackout windows, cash priorities, changed outlooks, and without a source, we shouldn't guess. But it belongs in the ledger.
Then the 2026 business transfers we mentioned, RapidFit and eyewear, both handed to their own management teams. Multiple outlets covered those, so the events are solid. And the pattern across all of it, buyback, listing, spin-offs, is a company managing itself like a mature business rather than a growth story.
Which is jarring in this industry because almost everyone else in additive manufacturing is still telling a growth story, whether or not they have one. Materialise choosing the mature company playbook is itself a turning point. It's them saying, we're done pretending the hockey stick is next quarter. One claim floating around that I want to explicitly park, the idea that early 2026 results showed surging profitability. We could not find that in a verifiable source. Stable results in 2025, yes, per Voxel Matters. Surging, no. Don't let the stronger words sneak in.
Also notable for a 35-year-old company. No scandal section, no accounting drama, no recall, no ugly lawsuit in our research. Some of that might just be sourcing limits, but a genuinely quiet record over that long is itself unusual in this industry.
Boring is underrated. Ask anyone who bought stock in the exciting additive manufacturing companies of 2021.
Future watch. Let's separate confirmed signals from speculation. Confirmed, the new CO additive manufacturing serial manufacturing tools per 3dprint.com. Confirmed, the Peak CMF implant launch per All3DP. And confirmed this one's interesting and an investment in a company called Replasia, reported by Metal Additive Manufacturing Magazine.
So the deployed capital is going two directions, deeper into production software and deeper into medical devices. That's the whole strategy legible in 3 announcements. No hardware moonshots, no consumer plays, no adjacent market adventures.
The speculation layer is where it gets uncertain. The bull case, as additive manufacturing shifts from prototyping to serial production, the software requirements explode and Materialise is the incumbent workflow layer. Plus, medical keeps compounding because personalized implants are a structural trend, not a fad.
The bear case, the OEM squeeze we talked about, where machine makers bundle good enough software and the neutral layer loses its toll booth, plus the arithmetic problem if margins are the whole story and revenue stays flat. Eventually you run out of things to prune. Efficiency is a floor, not an engine.
What would you actually watch for over the next year? Concrete signals.
3 things. First, whether the medical segment's growth becomes visible in the overall top line, because that tells you the drag from other segments has been cleared. Second, CO additive manufacturing adoption announcements, real name production customers, not pilot programs. Third, the OEM relationships. Every renewed or deepened partnership with an HP or an EOS is the moat holding. Every OEM launching a competing workflow suite is the moat eroding.
And I'd add a fourth, the buyback. Whether it resumes, stays paused, or quietly disappears, tells you how management actually feels about its own cash position, whatever the press releases say.
Good one. Capital allocation is the least spinnable disclosure a public company makes.
Let's land this. Why Materialise matters. It's the closest thing additive manufacturing has to infrastructure. Not the machines, not the parts, but the workflow layer that makes serious production possible, plus a medical business that's arguably the best proof anywhere that 3D printing creates value. You literally cannot get another way.
Who should pay attention? Anyone running or planning industrial additive manufacturing production, because you'll probably touch their software whether you choose to or not. Anyone watching the medical device space, and honestly, anyone trying to figure out what a sustainable additive manufacturing business model looks like, because This is one of the very few companies with 30 plus years of evidence.
The fair criticism baked in. A lot of the impressive sounding numbers are company claims we couldn't independently verify. The growth story is genuinely unproven right now, and the discipline narrative could just as easily be described as a company getting smaller gracefully.
The one question lied to track. Does the software and medical focus produce actual top-line growth, or is Materialise settling into life as a profitable, stable, permanently mid-sized company? Both are respectable outcomes, but they're very different stories, and the next few earnings reports will start telling us which one this is.
A company that survived every hype cycle by refusing to believe any of them. There are worse epitaphs, and it's not even done yet. That's the show. We'll see you next week.